Welcome back, everyone. It's time for a full portfolio update. This is where we look at the story fund. This is a concentrated, aggressive portfolio in only 6 different holdings with over $164,000 in value. I'm investing in these companies with the goal of outperforming the S&P 500. Now, I don't just talk about that. I don't just talk about stocks and show little snippets. I show the full thing. All my invested capital, the gains or the losses, every single holding, my gains and losses in every single holding, and I show you the returns benchmarked against the S&P 500 exactly, as if I bought either one of them at the exact same time to be perfectly accurate. And what you're going to see in this episode is my performance overall benchmarked against the benchmark, which is the S&P 500. You're going to see an in-depth analysis on every single company I own. We'll be going over Qualtrim and all the fundamentals which are in Qualtrim now. And on top of that, we'll be looking over my watch list, the companies that I may be buying in the future. So this is going to be a very full episode, and I hope you appreciate the transparency here. If you do, like the video, subscribe to the channel, ring that little bell notification so you get an update anytime I upload. Now let's go ahead and jump in. Now this is the portfolio we're looking at. It's called the Story Fund. It's worth over $160,000 currently. We have just a little bit in the green, $7,500 in the green. And again, the stated goal since the very beginning of this portfolio was to beat the S&P 500. I've read a lot of investing books. I've studied a lot of great investors. The big difficulty in investing is to outperform the broader market. In the US, we consider that benchmark to be the S&P 500. That is the gold standard. It's what almost every single index fund, it's what almost every single hedge fund, it's what almost every single mutual fund is benchmarked against overall. It is the opportunity cost for investing. If you're investing and you're not beating the S&P 500, you may as well invest in the S&P 500. So that is the stated goal of this portfolio, and it remains the goal to outperform the S&P 500. The timeline I gave myself was by the end of 2025. So we're coming up with just 2 more years, only 2 years. Now, the way this portfolio started off, if we look at the actual performance chart here, it was in 2021, and for a few months, things were going okay during this beginning part here. Seemed like we were doing okay. We were keeping up with the market, but then we know what happened. In 2021, going into 2022, we had the Fed jacking up interest rates. We had everybody suddenly have a change of heart in the type of companies they wanted to own. And a lot of the companies that were doing really well started to tumble. My portfolio suffered from a few critical mistakes. Now, I'm not blaming macro. I'm not blaming the Fed. I blame myself for this. I made a few misjudgments. One of them was I followed Charlie Munger into Alibaba. I lost some money on that. The other one was I bought my biggest holdings, Netflix and Amazon, a little too high. Paid too much for them at the time. And what happened was they really sold off harshly in 2022. So we had a big sell-off here. Now the S&P 500 in red here, you can see that it went down, but my portfolio in blue, the Story Fund in blue, went down way further. We got crushed. This was it was a depressing time. Honestly, it was a little bit, you almost lose hope when it goes down this much. When I saw Netflix tumble 50% and then 60% and then 70%, it was very troubling. Emotionally, it was just like draining. I look at that and I think it was a difficult time. And then to add on to that, Bill Ackman, he was so glowingly positive about the company when he bought in. He quickly sold out. And that was right around here. This was the lowest point in the portfolio. Netflix and Amazon were in the dumps. The companies were not doing well. Investors didn't want anything to do with them. During this time period, I also decided to change strategies a little bit. In most cases, when people fall behind in something like this, the natural urge is to increase risk. You want to take on more risk to gain back what you've lost. And that is the human nature error that I wanted to avoid. Instead of taking on more risk, I decided during that time period to reduce the amount of risk I had. I decided to get rid of every speculative stock I owned. During this time period, I owned companies that were a bit more speculative. Companies like DoorDash and Spotify, a lot of companies that had weaker cash flows, they're less capitalized, they didn't have as strong of business models, and I decided to shift over to more predictable companies. Companies that I really thought would have strong recoveries, very predictable futures, and they would generate incredible amounts of cash flow. I doubled down on Netflix during this time period. I bought more Amazon during this time period. The two companies that I thought were very predictable and had strong cash flows. I dumped the companies that were more speculative. The ones that were a little bit more hazy or murky in my mind, I got rid of those. And that decision there made for a pretty strong recovery. During the next year, my portfolio traded up and down over time, but in 2023, we've made an incredible recovery with my stock picks. For example, if we look at this right now, we're only up $7,500. But remember, in 2022, we were down almost $60,000. It was in the red like crazy. It looked really bad. This year to date, we're up 51.5%. We beat out the QQQ. We beat out the S&P 500. That's $54,700. That is how we've recovered with an incredibly strong performance in 2023. What has given that strong performance? Amazon up 60%, Netflix up 47%, Google up 40%, Microsoft up 49%, Apple up 52%. A brand new holding to the portfolio is S&P Global. So this one simply has not had time. But all my core positions, in fact, every one of them this year has widely outperformed the market. These are all very cash flow positive companies. They've had a tremendous recovery, and that's where we've closed the gap. So looking at it this year, you can see that the gap right here, the beginning of the year, it was about 35%. We were way behind. Right now, the gap has closed most recently as of today to where we're now less than 5% away from the S&P 500. The S&P 500 has 9.82% since the beginning. This is benchmarked with every single buy I've done. My portfolio has 4.73%. So again, around 5% difference. So we're a little bit behind, but right now we have a lot of momentum. So the big theme of the past 2 years has been closing the gap. Catching up, not through taking on greater risk, but reducing risk, refining the strategy, focusing on cash flow positive companies, doubling down on my most significant bets, which I believe are the most predictable companies in the market. That is how we've caught up to the S&P 500. And now looking forward over the next 2 years, I want to talk about how I believe we'll pull ahead of the S&P 500. I believe the most enduring and reliable investment strategy over all different market environments is investing in companies that have growing cash flows. Plainly put, I believe that's the strongest form of investing. Now, determining which companies will grow cash flows is a whole different thing, but I believe in general, if a company has a great balance sheet, high barriers to entry, if it has ample growth opportunity, and it has high margins where it can continually grow more profits and cash flows, that is a good company. Indicative of a good company is pricing power. So when I see companies repeatedly raise prices of their products, that's another thing that I find very attractive. Now, when we look at the Story Fund, this is a collection of companies that I believe mostly meet those qualifications. None of them meet it perfectly. None of these investments are perfect, but they're as close as I can find. Now, let's go ahead and look at the most recent quarter of each of these companies and see how the fundamentals are developing. And remember, we want a strict view of cash flow. I want companies growing their cash flows over time. So let's go ahead and start off with my largest holding here, which is Amazon. I have $58,000 invested in this company. It makes up 35% of the Story Fund. Let's take a look at the most recent quarter here on the revenue. This is what it looks like. In my opinion, it looks right in line. In fact, if we zoom in on the past 10 years, that doesn't look too bad, does it? It zoomed up a little bit ahead of its normal trend during 2020. That's expected. But Amazon didn't give up that market share. They kept it. They kept growing after 2020. Which is pretty incredible when you think about that. They gained a bunch of market share, then they kept growing. Their latest quarter right here has $143 billion in revenue. Now, the top line revenue for Amazon doesn't really say all that much because, well, there's all these different business segments and they all have different margins, but this does give us an idea that the overall company's growing. Let's go ahead and take a look at the cash flow here. Again, the biggest thing we're looking for are trends and future predictions of growing cash flows. Now, this is over the entire timeline, going back to 1997. So Qualtrim gives you a lot of data here, but I'll zoom into the past 10 years. This is what it looks like, okay? In fact, I'm going to zoom into the past 5 years so we can see this clearer. Last quarter, they generated $8.74 billion in cash flow. Now, if we go back 1, 2, 3, 4, the same quarter last year, they generated minus $4.97 billion in cash flow. So we went from minus $5 billion to positive $8.7 billion. But with these big tech companies, you have to be careful about stock-based comp. So I have another chart here that shows that in line with the cash flow. The reason that I factor in stock-based comp is because it dilutes you and it dilutes your ownership of the cash flows. For example, there's some companies that generate, technically speaking, positive cash flows, like Unity, but when you factor in the stock-based comp, they're actually diluting you at a faster pace than they're generating cash flows. So what we want to see is net cash flow even on a diluted basis. So with Amazon, we can see something revealing here. Again, this is the most recent quarter. The cash flows came in a little bit above dilution there. But if we go back 4 quarters ago, 1, 2, 3, 4, this quarter was the same one last year, and they have around the same amount of stock-based comp. So the dilution was around the same as it was a year ago, but the cash flows increased dramatically. This is a huge fundamental development in the right direction. If we want to net this out to make it more clear, we have that chart right here. This is simply the free cash flow per quarter minus the stock-based comp. And we see right here, the most recent quarter, it was $2.91 billion. So almost $3 billion in free cash flow. Not their best quarter, but still a positive one. If we go back 1, 2, 3, 4, it was minus $10.5 billion. So they went from almost $10.5 billion in the red to positive $3 billion. A net difference of $13 billion in cash flow year over year. That is a massive improvement. Plus $13 billion in a single year shows that Jassy, the CEO of the company, is making progress on cutting costs and increasing profits. If this keeps up year over year, if they keep growing $10, $15 billion in cash flow, this company is going to be putting up a lot of cash in the near future. Andy Jassy has said repeatedly that he's going to get costs under control. Now that's a promise from the CEO. Sometimes CEOs lie, sometimes they're full of it, so we verify by the numbers. When I look at the numbers here, I can see verification that he is fulfilling his promise. Last quarter was $12.48 billion in CapEx. Last year, the same quarter was $16.38. So $16.38 down to $12 billion. CapEx spending is going down while revenues are growing. That is a more efficient company, getting costs under control, growing cash flows. As long as Amazon can continue on this route of growing their top line, growing the ads business, growing AWS while getting CapEx down, the margin should expand and the cash flows should be enormous over the next 2 years. That is what I'm counting on with this holding. So with holding number 1, with Amazon, the reason I believe it will outperform is because of substantial growing cash flows and a re-rating of the stock as its accelerated growth. I think that will drive the price increase of this company. Holding number 2 in my portfolio is Netflix. This is the next largest one at a 23% position. So it's a very meaningful one. I have $38,000 in this company. Now, Netflix has been through a bumpy road. We know the history of it. There's a lot of doubt a couple years ago that they would be able to recover from HBO and Disney and all these other companies going into streaming. We've seen what's happened over the past couple of quarters. Netflix seems to be doing okay. The stock is now back to $433, and I believe over the next couple years, I don't know for sure, but I believe there is a chance for this company to get up to around $900 per share, to be a double from here. So let's go ahead and talk about how Netflix gets there. First of all, let's go ahead and take a look at the revenue growth. Netflix has re-accelerated revenue growth in the past quarter, growing 7.7% year over year. In the fourth quarter, they plan on growing the revenue by around 12%. So revenue growth took a little bit of a dip, but I believe that was because of pull forward in 2020. You can see this quarter right here, the revenue grew a little bit above line, and that was because of the pandemic. Everybody was stuck home. Netflix got a lot of pull forward. So you had some pull forward here, some pull back there, but overall you have a very solid trend of revenue growth. It looks good to me. Going back to 2013, Netflix is doing its thing, growing its revenue above 8% per year. And the re-acceleration of revenue growth is a very positive thing for this company. They need to grow revenues for this stock price to double. They really have to, because part of the way they grow the cash flow is by the operating leverage of the business. So let's go ahead and take a look at the cash flows here. Now we have the cash flows going back all the way to 2002. Let's go ahead and zoom in to the past 10 years here. So Netflix went from one of these money-losing companies that was reinvesting into their content slate, growing their subscribers. This whole period up until 2019 was a period of negative free cash flow. Netflix never made positive free cash flow during this entire decade. Now, The rationale here was pretty simple. Netflix could have generated cash flow. That was the idea, but they thought it would be better to invest their money in content, gain more and more subscribers, widen their moat, and get to scale. The most meaningful thing for a streaming company, the most meaningful word is scale. If you don't reach scale, you're in trouble. So Netflix really wanted to get to scale where they could offer tremendous content budget and have hundreds of millions of subscribers at the same time. Once they got to scale in 2020, this period right here is where they had, I would say, shaky cash flows. Now, finally, we get to the past 5 quarters. The past year, this is the era of positive free cash flow. This is what I've been predicting. Netflix has said repeatedly on their earnings calls, on their transcripts, that they are moving to positive free cash flow every single year. They're at scale. They're profitable. They have operating leverage. They have good margins. Their margins are going up. So they can produce real cash. And this is real cash, not diluted fake cash by stock-based comp. This is real money even after dilution. So Netflix now for the past 5 quarters is in the era of positive free cash flow. For the entire year of 2023, they are saying that they'll have roughly $6.5 billion in free cash flow. It's a lot of cash flow for a company that previously wasn't generating any. Now, some of this free cash flow is because of the impact of the writer strike and the actor strike that's ongoing. That has probably affected it around $1 to $2 billion in positivity. So when that ends, they'll spend a little bit more money next year. I believe next year, Netflix will have at least $6 billion in free cash flow, and then it will only grow from there. My guess is in the next 2 years, Netflix will be able to have at least $10 billion in free cash flow per year. That seems really aggressive, and that's far above what the street is pricing in, what other investors are pricing in. But I've seen the operating leverage with this business, and Wall Street has continually been wrong with it. They've underpredicted their free cash flows almost every single year. Another thing I'll mention in the story of Netflix is we're now back to the other studios capitulating. They're now licensing their content back to Netflix. They need money. So Netflix is now, beginning December 1st, they're getting Man of Steel, Batman and Superman, Suicide Squad, Wonder Woman, Justice League, Birds of Prey, The Suicide Squad, and Wonder Woman 1984. Lots of these DC Universe movies. Then we just heard news just today that Netflix is getting Batman, The Batman, Warner Media's. So they're now picking up more content from other services and lots of HBO series as well. So now we're back to the days of Netflix growing their top line, growing their cash flows, growing their subscribers. Last quarter, they gained 9 million subscribers. Next quarter, they're projecting to gain 9 million subscribers. That is massive growth. Even when we look at the ad tier of Netflix, now current day, the most recent report just this week, they have 15 million users on the ad tier. So we have cash flow company number 1, Amazon, growing its cash flow rapidly year over year. We have Netflix, which is also a cash flow company, growing to $6.5 billion in cash flow in 2023. And the CEO and management have said that they're going to produce substantial cash flows in 2024. And I believe them. I believe that both of these companies will outperform because they are growing cash flows much faster than the market. Now we move on to company number 3, which is Google. Google was one of the rare companies in my portfolio that got beat up after the most recent earnings report. It was one that sold off, and that's a little bit unexpected. Netflix went up like crazy, Amazon went up like crazy, Microsoft did really well, but Google sold down 9% after the latest earnings. And I don't think that was deserved. I think Google's doing really well. Let's go ahead and take a look at the top line revenue. It grew 11% year over year. 11% growth is good. That's fast growth. I didn't see any problems with the top line growth. We look at the cash flows of the company. Again, we want growing cash flows year over year and especially undiluted growing cash flows. Now, Google is a company that has a lot of stock-based comps, so we want to factor that in as well. But what we see here is cash flows on the most recent quarter of $22 billion. We go back 1, 2, 3, 4, and it was $16 billion. So at least year over year, they grew cash flows like crazy. $16 billion to $22 billion is a 40% increase in cash flows. Now that's 1 year, so it's a little bit more lumpy, but overall the trend still looks good. 5 years, it's 23%. Over a 2-year period, it's 10%. We have double-digit cash flow growth any quarter over the past 5 years. Now, when we look at the stock-based comp next to it, we can see that that does eat up a lot of the cash flows, roughly 30%. In fact, we have the calculation right here. It's 28.2%. So the free cash flow yield before stock-based comp is 4.7. After you factor that in, which you should, we have the calculation right here on Qualtrim, it's 3.4%. 3.4 is still pretty good. Now, if we bring up this chart here again, the CEO of Google recently said that they're getting costs under control. And again, I trust the CEOs, but I also want to verify what they're saying in the data. You have to verify because some CEOs have a bit of lying that they do. They say things that they don't end up following up on. And in this case, the CEO of Google is doing what he said. He has laid off employees. He has cut costs. And we see that in the numbers by the stock-based comp not accelerating at the same speed. It's growing slower. As they lay off employees and they pay severance, there's going to be some one-time expenses, and that's unfortunate for the Google employees that got laid off. But overall, it's a better thing for the long term of the company as they'll have a more efficient business where they can return more cash to the shareholders. And we can see that over time. This is, again, the net of the free cash flow and the stock-based comp. And you can see that last quarter was the highest ever for Google. If we look at this over different time periods, it looks like it's beating out 2021 here. If we look at it all time, you can see the dramatic rise in free cash flow. And again, this is with stock-based comp netted out. That is a dramatic improvement. This looks great. As a Google shareholder, I didn't see anything wrong with this. That's why I was perplexed with the sell-off here. I realized that investors were a little bit disappointed with Google Cloud and the slower growth than anticipated, but Google Cloud is already profitable, and it's going to be an extremely profitable business in the future. Investors in Google should be relaxed. They should sleep well at night. The company trades at a reasonable, if not low valuation. It's generating growing free cash flows every single quarter. The CEO is doing what he said he would do. So when I look at Google, I think this company is undervalued right now. I think it has very good downside protection. It has multiple profitable businesses. The biggest risks I see for Google are government regulations and intervention, the DOJ suing them. That puts a little bit of a question mark, but I think the company will do fine. So I'm betting big on Google, 20% of my portfolio roughly, and I'm going to continue with this investment. Now, next up, we have Microsoft. A few things I'll mention about Microsoft. This is a company that I like so much, I have it in both portfolios. I own a ton of Microsoft. I'm in the green by a wide amount on both portfolios. And that's because when this company traded at 220, I could not get over how easy of an investment that was. It traded down right here, again to $220 per share. It was such a low valuation for such a high quality company. And I made video after video. I made it the title of my video that I'm buying Microsoft. I think the fair value is $350. I said it repeatedly. So you can't blame me if you didn't buy Microsoft. I was saying openly that I'm buying a ton of this company, and it's been one of the easiest investments that I've ever made. One of the ones that's just the most predictable, the most reliable. That's why I have a huge holding of it in both portfolios. Here's in the passive income portfolio. I bought a lot of Microsoft there as well. It's up 15,000. So this is one that I've been very vocally bullish on in both portfolios. I've invested a huge amount into it. And Microsoft is a company that I consider, you know the term give me in golf? If it's a give me, it's a gimme, it's so easy you almost can't miss the shot. It's like a 3-inch putt. You just can't miss. So this is what Microsoft represents. It's a company that has been such an easy investment case that you almost couldn't miss. That's what I thought of this company at $220 per share. Now, it's moved up a lot. It's up to $350. So I don't think there's as much room for outperformance here. It's trading at a much higher PE ratio, a lower free cash flow yield. So I'm not buying it right now. The company for me right now is a hold. And if it continues to trade up, if it goes up to $400, at least in the story fund, I might look for transferring it into a different holding that has a little bit lower of a free cash flow yield, higher of a free cash flow yield. Because right now, the valuation is the only concern for Microsoft. But other than the valuation right now, Microsoft is such an incredible company. It is the poster child for the perfect fundamentals. If we zoom in on the past 10 years here, we look at the free cash flow, 1, 2, 3, 4. It was 22% growth year over year. So fast growth for the free cash flow. We look at the stock-based comp, much less than Google, much less than Meta, much less than Amazon. They have a very efficient way of paying employees, producing value. When we look at this netted out, this is what it looks like. 23% growth year over year. And overall, very, very consistent. Microsoft has over 80% of their revenue as residual subscription revenue. The holy grail of a business model is to have that type of diversified revenue. So right now, Microsoft is an 11% weighted holding. And I like the positioning right here. I don't think it's problematic right now. But again, it's already ran up so much that I am a little bit concerned about further upside with Microsoft, but it's just too good to sell it. So right now I plan on holding the company unless it gives me a reason to sell. If it went up to $400, $410, I would probably take some gains at that point and look at a different time to reentry. But as of right now, again, it's a continued hold. Next up, we have S&P Global. S&P Global is a tech company. In fact, it's a very good tech company. Now, when you put S&P Global next to Microsoft, Google, Netflix, and Amazon, it seems like less of a tech company than these companies, because these ones have products that you interact with. You watch Netflix, you buy stuff off of Amazon, you use their web service. Google, you're on YouTube right now. So a lot of these products are more relatable, but S&P Global is very much a tech company. They just operate in categories that are less relatable to the end user. They're mostly operating with a lot of data. The company supplies data to indices, to different contracts for different companies like Yahoo Finance, like Seeking Alpha. They provide different companies with data about the markets, and the company is all about markets. They own the Dow Jones indices, so they get a fee anytime someone invests in the S&P 500. They earn money off of all of that. They also are a big credit rating company, so they provide data to different businesses on the credit worthiness of a company. So the whole business is data, 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 and they operate in different segments. Data is very valuable, so they can increase the prices year after year after year on a contractual basis. Data doesn't require a lot of CapEx, so they don't have to build a lot of warehouses. They simply contract with AWS and have some servers host their data. And the business overall is very lean and has a lot of pricing power because of the proprietary data they have. So I like the company overall. I've gone over the fundamentals many times, but recently S&P Global sold down after Q2. So going into Q3, it was selling down a lot. Q3, they had a massive recovery. It's really popped after this latest earnings. The reason that the company popped was because S&P Global basically did everything they said they're going to do. They reiterated their guidance, they reiterated their free cash flow, they reiterated every part of their previous guidance. So on the earnings call, they're basically saying that for the full year, they're going to still execute. Things aren't slowing down for them. And all the businesses that S&P Global operate in are growing. Every single segment has revenue growth and they have high margins. Now, what they've said is that they're going to have $4.3 billion in 2022. So the free cash flow looks something like this, around 4.1 to 4.3. Now, this isn't all organic growth because they did a big acquisition. So some of this is going to be adjusted growth. But again, what we're looking for, what I'm choosing to look for are growing free cash flow companies. S&P Global's doing this on a per share basis. They're going to be growing that free cash flow very quickly, like they have with their long-term trend. So this one makes up another 10% of my portfolio, another great tech company to add to the list. Now, the last holding in this portfolio is more of a placeholder. It only makes up 1.3%. So it's barely even a holding compared to these other ones. And basically, it's just gains at this point. I have $1,400 in gains for a $2,000 position. So a lot of this is gains. I have Apple here. And to be honest, I'm looking at swapping this one out. Apple is slowing down with their growth. And with this portfolio, the Story Fund, I'm looking for growing companies that will have substantial free cash flow growth. I might look for a company outside of Apple to fulfill this slot. So I might be swapping out Apple for a new company in the near future. And I want to go over some of the candidates. One of the candidates that I have on my watch list is Salesforce. This is one that I recently held. I sold out around, I believe it was around 215. So I sold the company during a little bump and it's traded down a bit, but it just hasn't traded down enough. The big problem I have right now with Salesforce is the valuation. 24 PE ratio, 2.2 free cash flow yield. But either way, once this company gets back to a better valuation, I may take the leap back into it. The next company on my watch list is FICO. This one is a frustrating stock because I've had it on the radar for a long period of time. I really like the business model. It's in the analytical business, and of course it's in the credit rating business, mostly for loan originations with cars and with homes. This year that should be slowing down a little bit, but it's really not because of their incredible pricing power. FICO pushes through price increases all the time, and the banks and the lenders and everyone else just accepts them. There's nothing they can do about it because FICO is such a well-used product. It has so much market share that they have this incredible pricing power. The stock is frustrating to me because it goes up every single day, a lot, and there's seemingly no end in sight. Even when the stock dipped, it dipped down a little bit here. I was tempted to buy this dip, but I thought, you know what? It was right back to where it was just a couple weeks ago, so it's not really that big of a dip. But what do you know? Right after the dip, it spot back up. It's up another like 7% in just a week. So this is a company that's really tough to get into. You have to find a time period to buy into this one. And in terms of free cash flow growth, FICO's free cash flow growth is insane. If we look at this on a per share basis, we can look at the free cash flow per share here. Look at this. It's basically exponential at this point. And again, that's because of their price increases. But right now, the valuation is extreme for FICO. The company has very high expectations, and I'm not going to be buying into it unless I see better value here. Next up, we have Moody's. This is another one that I've had on the watch list for a long period of time. I think it has a very strong business model, similar to S&P Global's credit rating business, but they also have an analytical wing that I think is very attractive. Moody's is basically taking the cash flows out of their credit business to build up this analytic business for companies. So they're part credit rating and they're part SaaS, and I like that. Moody's is a quality company that I may enter into if it has another big dip. And then finally, we have Visa. I own a lot of MasterCard, but looking at Visa, it's so good. It has a lot of the same attributes as MasterCard. The revenue growth seems to never slow down. Another year, another 11% year-over-year revenue growth. The free cash flow is incredible. Look at this chart. It's hard to beat. And there's almost no dilution. So you don't have to worry about dilutive stock-based comp. This company has such an efficient model that they can grow cash flow, they can grow revenue, they can do this continually. And they don't take on any risk of lending at the same time. So this is a very attractive company to me. In fact, I think the valuation's fine right now. The reason I don't own this one is because I have so much MasterCard already. But in the story fund, I may buy this one if it trades down enough. If I get a nice juicy dip on it, I'll be buying into Visa. So there we have it, my entire portfolio, my performance, and the watch list. If you want to see how this turns out over the next 2 years, if I end up beating the S&P 500, make sure you subscribe to the channel with the bell notification on. If you want to see exclusive content, have access to a huge Discord community, or have access to Qualtrim.com, check out the Patreon. If you join new today, you'll have the entire month for free. No strings attached. So that's it for now. See you in the next one.